There's a company spending $20 billion to invent a robot that drives you to work.
Right.
And at the exact same time, a local dealer is terrified because they cannot get their hands on a 50-cent plastic bumper clip.
Yeah, it's wild.
Welcome to Auto News Talk. You know, if you look at the auto industry, it feels like we are completely split between two parallel universes.
Oh, absolutely.
On one side, you have companies betting absolute billions on this flawless AI-driven robotic future. But on the other side, you have the incredibly gritty physical reality of geopolitics, supply chain choke points, and, just the daily practical needs of the people actually driving and fixing these vehicles.
Yeah.
For anyone paying attention, it is forcing a massive reality check across the entire landscape.
That is exactly the terrain we are walking through. Think of the auto landscape as a massive suspension bridge.
Okay, I like that.
So the cables up at the very top, those are the high-flying tech valuations, the software dreams, the visions of full autonomy.
Right, the stuff that looks incredible against the skyline.
Yeah, exactly. But the concrete pillars actually holding the entire structure up, those are the physical supply chains, the raw materials, and the highly practical commercial vehicles getting actual work done.
And if those concrete pillars start to shake...
I don't care how strong your tech is, those high-flying cables are going to snap.
Okay, let's unpack this, because the ultimate high-flying cable in this industry is undoubtedly Tesla.
Oh, for sure.
And watching their strategy shift is wild. Honestly, it feels like a massively successful burger joint suddenly telling their investors to completely ignore the declining food sales because
they're about to invent a robot waiter.
Yes, exactly.
It is a profound pivot, and the financial weight of it is staggering.
Right.
One of our industry reports, analysts cut Tesla delivery outlook as heavy capex and falling demand raise cash flow risks, highlights a massive shift occurring beneath the surface here.
Okay.
The central insight is that Tesla's transition from their core auto business to robotics and autonomy is actively squeezing their financials, especially amid falling vehicle demand.
But wait, isn't that just a smart long-term play? I mean, if Tesla cracks the robo-taxi code, who cares if they sell fewer cars? Yeah. The software margins will dwarf the hardware margins eventually, right?
That is the bull case, certainly. But look at the sheer scale of the metrics the report lays out. Analysts are expecting a third consecutive annual decline in sales.
Wow, 3 in a row.
Yeah, and automotive revenue forecasts have been absolutely slashed. They went from an expected $138 billion down to about $72 billion.
Wait, down to 72? That is almost half.
Exactly. Meanwhile, their capital expenditures, so the hard cash they're spending on factories, AI chips, R&D, that is doubling to over $20 billion just to fund these autonomous and robotics bets.
Dropping from $138 billion to $72 billion in expected revenue, while simultaneously doubling the money you are spending out of pocket. That is a terrifying equation for any business.
It completely flips their financial model. In fact, here's the starkest number from the report. Wall Street models about $5.19 billion in negative free cash flow.
Wait, let me stop you there. For the layman listening, when you say they are facing $5.19 billion in negative free cash flow, that basically means after paying for the factories, the robots, the daily operations, they are bleeding over $5 billion in cash.
Exactly. More cash is walking out the door than coming in. And that's a massive reversal from prior expectations, which originally modeled a $2.27 billion surplus.
Oh, man.
We are talking about a potential multi-billion-dollar cash burn after years of positive free cash flow.
That is an unbelievable swing. So what does this actually mean for the company's value? Because they're still worth a fortune.
Well, it means Tesla's trillion-dollar valuation is no longer tethered to traditional auto sales. The core business is facing softer demand, lost tax incentives, and a generally aging lineup.
Right.
Even with aggressive price cuts, the lower-priced Model Y and Model 3 trims have underwhelmed. So the valuation is almost entirely dependent on Elon Musk successfully converting these massive autonomous tech bets into tangible revenue.
Because price cuts might drive a little bit of interest, but they absolutely crush your profit margins on the cars you actually do sell.
Precisely. Now, the one lingering limitation the outlook leaves open is the exact margin impact of those pricing actions versus the actual real-world uptake of their software revenue.
Right, because we don't know the adoption rate yet.
Exactly. We know the massive spending is happening, but we just don't know if everyday drivers adopting that software will outpace the shrinking profits on the physical cars.
Which perfectly illustrates that split personality we talked about at the top of the show. You have executives stressing over billion-dollar software margins, but If you are a listener working on the ground building, selling, or fixing these cars, you are stressing over something much more basic: raw materials.
And that brings us down from the cables to the concrete pillars of our suspension bridge. A supply chain briefing titled "Iran Conflict Risks for Auto Supply Chains" pulls us right back down to earth. The key takeaway is that geopolitical conflict in the Middle East is directly threatening the physical flow of raw materials needed for auto manufacturing and dealer repairs.
Which always sounds so abstract on the news until you realize what it actually means for a service bay.
Let's look at the mechanics of why this matters. The briefing points out that escalating conflict pushes oil above $100 a barrel.
Ouch.
Yeah. When oil spikes, freight and fuel costs jump immediately. But it goes so much deeper than just the cost of shipping. The Strait of Hormuz is a massive choke point for roughly 20% of global oil, yes, but it is also a key route for refined petrochemicals like ethylene and propylene.
And for anyone wondering why we care about ethylene, that is the exact chemical foundation used to make vehicle plastics.
Exactly. But it isn't just plastic, it's metal too. The Gulf region supplies about 9% of global aluminum smelting, and smelting aluminum requires a massive continuous amount of electricity.
So if energy gets disrupted,
Any disruption there sends shockwaves through the metal markets. And the U.S. imports the vast majority of its aluminum, exposing body panels, wheels, and lightweight vehicle frames to sudden cost spikes and lead time delays.
if you are a dealer listening to this, you know exactly what I'm talking about. You do not care about the geopolitics in the Strait of Hormuz when a customer is screaming at you because their collision repair has been delayed for 3 weeks.
Exactly.
And the briefing explicitly warns dealers to build buffer stock of fast-moving, plastic-heavy service parts like bumper covers and clips, as well as aluminum body panels. It is wild to think that a geopolitical conflict halfway across the globe means a local shop manager needs to hoard plastic bumper clips just to keep the lights on.
It highlights the extreme fragility of the system. Dealers cannot just sit around and wait for automakers to solve a macro-level supply chain crisis.
Right, they go under.
They have to actively manage their own profit and loss. They need to protect their fixed operations, review delivery routes, consolidate shipments, and start pre-ordering those aluminum panels for high-probability repairs immediately.
The real wild card here, though, is the endgame. The briefing outlines the threat, but what it doesn't answer is whether these pressures will culminate in outright parts shortages where you simply cannot buy a bumper, or if it will just trigger a cascade of higher costs moving down the tiers until the customer's paying double for the repair.
That is the exact tension. And speaking of higher costs and tight supply, if physical parts are too expensive or impossible to get, new car production slows down.
Oh, I see where you're going with this.
Yeah. And when new cars aren't hitting the lot, suddenly every used car on the road becomes an incredibly valuable asset.
Which completely changes the power dynamics of the industry. Because when an asset becomes that valuable, you start seeing absolute giants in the used car market, rushing to buy up their competitors to secure their pipelines.
That is exactly what is happening. Looking at a regulatory summary covering the CMA's clearance of the Aston Barclay takeover, we see how tough economic environments are drastically reshaping the used vehicle remarketing landscape.
Wait, I need to stop you there. Because on the surface, this makes no sense to me. Constellation, which is an absolute giant in the used vehicle auction space, buys up Aston Barclay, a smaller competitor.
Uh-huh.
And anti-monopoly regulators are just waving it through because the smaller guy was struggling. How does that work? Isn't the whole point of regulators to stop giants from eating their competitors and forming monopolies?
It is a great question, and it comes down to a very specific legal and economic framework. The UK's Competition and Markets Authority, the CMA, permitted this major used vehicle remarketing merger purely on a survival technicality. It's known as an exiting firm scenario.
Meaning they were bleeding out and on their way out of business anyway.
Correct. The merger went to a rigorous Phase 2 investigation run by an independent inquiry group. To make their decision, the CMA used a counterfactual analysis.
Okay, what does that mean?
In layman's terms, they looked at an alternate timeline where the merger did not happen at all. And they determined that without this buyout deal, Aston Barclay would most likely have closed its doors completely and ceased to exist.
Ah. So it is basically financial triage. The regulators are acting like battlefield medics. They are letting the healthy guy carry the wounded guy off the field, even if it breaks the usual rules of competition, just so the wounded guy's assets don't completely vanish from the market.
That is a brilliant way to look at it. They determined that no substantial lessening of competition, or SLC, would occur.
Because there'd be no competition anyway.
Exactly. Their focus was exclusively on national-level competition for large vendors. The CMA found that Aston Barclay's competitive constraint on BCA, which is the other massive player in the UK market, would be lost regardless of the buyout. The competition was going to disappear whether Constellation bought them or they simply went bankrupt.
That sets a fascinating and, kind of dangerous M&A precedent. If things are tough enough in the auto sector with supply chains and interest rates, regulators might just let the big fish swallow the struggling fish to keep the infrastructure alive.
It completely allows Constellation to proceed without any imposed remedies or conditions. It is a vital precedent for how regulators treat exiting firms during periods of intense economic stress.
But there is a huge blind spot here. What this regulatory decision completely ignores is how this consolidation will ultimately impact the smaller, regional vendors who operate outside that national level focus.
Yeah, that's true.
If the giants keep getting bigger on survival technicalities, the independent local auction houses are going to get crushed by the sheer scale of the consolidated megacorporations.
The national level focus definitely leaves the regional guys vulnerable.
So we have a fascinating spectrum here. We have companies like Tesla chasing futuristic tech valuations.
Right.
We have service bays hoarding raw materials, and we have corporate giants buying up failing competitors.
Yeah.
But then you have another strategy altogether, ignoring the high-tech noise, ignoring the corporate buyouts, and getting entirely back to basics to capture the small business market.
And nothing represents back to basics quite like the commercial van segment. We have two separate OEM updates tracking a very telling launch.
So the Ram van.
Exactly. One update focuses on the fleet targeting, and another details the Stellantis platform specs for the newly relaunched Ram ProMaster City.
I have to marvel at this pivot. We've got trillion-dollar robo-taxi dreams on one hand, and on the other hand, Ram is literally just saying, hey, want a box on wheels that fits your stuff. It is beautifully simple.
It is the ultimate pragmatic play. Ram is capitalizing on a massive void in the market. Previously, both Ford and Ram had exited this compact commercial van segment, leaving a huge gap.
Right, I remember that.
Tradespeople were forced to either buy massive, expensive full-size vans or try to awkwardly adapt compact SUVs for plumbing and delivery routes. Now, Ram is reintroducing a right-size, sub-$40,000 commercial van.
And they are doing it by shifting the size up just a bit to make it actually useful, right?
Yes, it is moving from the traditional compact class into a mid-size footprint. But the numbers, it is about 5 to 6 inches longer than a mainstream minivan like a Honda Odyssey.
Okay, so quite roomy.
Yeah. It runs on a 1.6-liter turbocharged 4-cylinder engine. Crucially, it is front-wheel drive only, and it sits just under 80 inches tall to ensure urban garage access.
That under 80-inch height is everything. If you are a city plumber or a delivery driver, you cannot run a business in a major metropolitan area if your vehicle cannot clear a standard parking garage roof.
Oh, absolutely.
And looking at the fleet targeting details, it hits the absolute sweet spot for utility. It can fit 4x8 building sheets and exactly 2 standard U.S. pallets, with a load floor exceeding 9 feet.
Think about the packaging efficiency required to achieve that. They're fitting 2 full pallets and a 9-foot load floor into a van that can still park in a city garage.
It's wild.
And the reason they can do that is the front-wheel drive layout. By pulling the vehicle with the front wheels, there is no bulky drive shaft running under the cargo area to the rear wheels, which allows them to drop the load floor incredibly low.
It's incredibly smart engineering.
Yeah.
And they are mitigating their own corporate financial risk by leveraging a highly successful global platform. According to the platform specs, they aren't guessing on reliability here. Over 1.5 million vans on the specific PSA K0 architecture have already been produced globally.
Exactly. They are taking a proven underlying chassis and skeleton that works perfectly overseas and bringing it to a market desperate for something practical and affordable.
Right.
It keeps costs down for tradespeople and fleets while ensuring the manufacturer isn't burning billions on unproven vehicle architectures.
Though it isn't a perfect vehicle for everyone. The one piece of the puzzle we are still missing from the fleet report are the official EPA fuel economy estimates for the new powertrain. For a fleet manager buying 50 of these, fuel efficiency is make or break for their operating costs.
And looking at the platform data, what it doesn't answer is the curb weight or acceleration metrics either. Plus, That front-wheel drive layout we praised for cargo space.
Yeah.
The lack of an all-wheel drive option might be a serious limitation for snowbelt buyers. A front-wheel drive van loaded to the ceiling with heavy pallets might really struggle for traction in a harsh winter environment.
Oh, that's a really good point. So
Okay.
let's pull all of these threads together because we have covered a massive amount of ground.
Yeah.
And if you look closely, there are some undeniable cross-currents defining where the auto industry is heading.
If we look at the big picture, three major themes really jump out from these sources. First is capital reallocation.
Right.
You have two radically different approaches to spending money. You have Tesla draining funds from their traditional auto sales to place a massive high-risk bet on AI and robotics. Contrast that directly with the Ram ProMaster updates, where Ram is doing the exact opposite, aggressively conserving capital by recycling an existing proven global platform rather than building from scratch.
It's the visionary bet versus the proven utility play.
Exactly. The second theme is supply chain fragility versus practical needs. The Iran conflict briefing highlights severe macro-level raw material stress. Oil spikes, plastic shortages, and aluminum bottlenecks.
Right.
But on the ground, as we see with the Ram launch, businesses just need basic, functional vans to do their jobs. The macro fragility of the supply chain is directly threatening the micro utility of the people doing the work.
And the third theme is clearly market consolidation. As we saw with the CMA clearance of Aston Barclay, when times get tight and supply chains get stressed, the bigger players use the economic pressure to swallow the weak.
And within those themes, we are left with two major tensions. First, the tension of high-tech versus traditional utility. You have the explicit contrast of Tesla's futuristic, high-capex robotaxi focus operating in the exact same industry as Ram's highly practical, analog focus on fitting two wooden pallets into a front-wheel drive van.
It really does feel like two entirely different industries that just happen to share the same name.
It really does. And the second tension is global risk versus local needs. The massive global supply chain risks like disruptions in the Strait of Hormuz or global aluminum smelting are crashing directly into the hyper-local needs of a dealer just trying to stock bumper clips or a plumber just trying to park in a city garage.
So what is the practical takeaway for you, the listener? Whether you're an investor looking at auto stocks or a professional running a dealership, success isn't just about placing the best visionary bet on the future.
No, not at all.
It is about aggressively managing your immediate physical constraints. It is about managing your logistics costs, protecting your used inventory, and securing your part supply before the macro trends hit your front door.
The vision for the future is important, but the execution of physical realities is what keeps the doors open.
And that wraps up this segment of Auto News Talk. The auto industry is currently staring at the stars while trying not to trip over the supply chain.
Well said.
As a next step, keep a close eye on how OEM pricing actions hold up as raw material costs start knocking on the service bay doors. Thanks for listening, and we will catch you next time.